Everyone said Bitcoin was supposed to protect you from inflation. Digital gold, they called it. A fixed supply asset that no government could print away. So why right now, with inflation running hot and the dollar losing value, is Bitcoin down almost 50% from its all-time high while gold is sitting at record prices around $5,000 an ounce? That's the question a lot of people are asking, and honestly, the answer is more interesting than you might think. What's up? I'm Sats, and today we're making sense of Bitcoin, inflation, and whether the digital gold story is dead or just delayed. Let's keep it simple. Since late 2025, Bitcoin has dropped from an all-time high of around $126,000 down to roughly $69,000 today. That's a fall of nearly 50%. Meanwhile, gold has done the opposite. It's been climbing steadily and is now trading around $5,000 an ounce, a record high. At the same time, US tariffs are pushing prices higher on everyday goods, inflation is sticking around longer than the Fed hoped, and global markets are in a state of genuine uncertainty. On paper, this is exactly the environment where Bitcoin was supposed to shine. High inflation, dollar pressure, geopolitical chaos. So why is gold going up and Bitcoin going down? Here's the thing. To understand the answer, you first need to understand what an inflation hedge actually is and why Bitcoin's relationship with that idea has always been more complicated than the headlines suggest. An inflation hedge is an asset that holds or grows its value when the purchasing power of currency is declining. Gold has been doing this job for thousands of years. When investors get nervous about inflation, war, or government debt, they buy gold. It's almost automatic at this point. The behavior is baked into how institutions think about their portfolios. Bitcoin was built with the same logic in mind. Fixed supply of 21 million, nobody in charge, no printing press. On paper, it checks every box. And for a long time, the digital gold narrative was gaining real traction. Institutional investors were buying it. ETFs launched in the US, companies were putting it on their balance sheets. On paper, it makes sense. But in reality, it's more complicated. And this is the part that most Bitcoin videos don't want to talk about. As more institutions entered the Bitcoin market, something unexpected happened. Bitcoin started behaving less like gold and more like a tech stock. Right now, Bitcoin's correlation with the S&P 500 sits at around 0.55. That means when the stock market falls, Bitcoin tends to fall with it. And when interest rates stay high and investors move away from risk assets, Bitcoin gets sold alongside equities, not alongside gold. This is why Bitcoin isn't acting like gold right now. In February 2026, when Trump announced new global tariffs, Bitcoin dropped 5% in a single day. Gold went up. In early March, when US and Israeli forces struck Iran, Bitcoin fell while gold absorbed $16 billion in ETF inflows. Bitcoin ETFs actually saw nearly $4 billion in net outflows that same month. That's not what a safe haven is supposed to do. And it's fair to ask whether the whole digital gold thesis was wrong. If you bought Bitcoin expecting it to protect you from inflation, what you're seeing right now probably feels confusing. Maybe even a little betraying. So let's actually answer the real question here. Will Bitcoin ever behave like gold? Here's how I think about it, and I want to be honest with you rather than just telling you what sounds good. Bitcoin is not currently behaving as an inflation hedge. Not in the short term. Right now, in this market, it is behaving as a risk asset. When sentiment turns risk off, which means when investors are scared and moving to safety, Bitcoin gets sold. That's just the reality of where we are. But here's the contradiction, and this is the key difference most people miss. It doesn't mean the underlying logic of Bitcoin as a long-term store of value is broken. The fixed supply is still fixed. The Fed can still print dollars. The US debt is still growing. None of the structural reasons for Bitcoin's existence have changed. What has changed is who owns Bitcoin and how they think about it. When it was mostly individual retail investors and early believers, Bitcoin moved on its own story. Now that hedge funds, asset managers, and ETF flows dominate the market, Bitcoin moves with their broader portfolio decisions. And in a risk-off environment, those portfolios get de-risked. Bitcoin goes with them. And that's the key difference between where Bitcoin is today and where it's heading. The analyst firm Messari put it clearly earlier this year. They said that over time, tariff-driven economic instability could actually be the catalyst that finally causes Bitcoin to decouple from equities. The logic is this. If tariffs persistently erode the dollar's purchasing power, if deficits keep ballooning, and if trust in the traditional financial system continues to weaken, investors may eventually start treating Bitcoin the way they treat gold. Not as a tech bet, but as a monetary alternative. Larry Fink, the CEO of BlackRock, the world's largest asset manager, said something striking in early 2026. He warned that if the US doesn't get its debt under control, America risks losing its reserve currency status to digital assets like Bitcoin. That's not a fringe view. That's the head of a $22 trillion firm. So where does that leave a beginner trying to make sense of all this? Here's my honest take. Bitcoin is not a reliable inflation hedge right now, today, in the short term. If you buy Bitcoin hoping it will protect you from this month's inflation numbers, you may be disappointed. The market doesn't work that way yet. But here's what that doesn't mean. Bitcoin is built on a logic that becomes more compelling the longer the current macro environment persists. High debt, persistent inflation, currency debasement, and institutional distrust of government money. Every year those conditions continue, the case for a fixed supply alternative gets stronger. The difference between Bitcoin and gold right now is not a difference in principle. It's a difference in maturity and trust. Gold has 5,000 years of history as a store of value. Bitcoin has 17 years. It hasn't had long enough to fully escape the risk asset category in institutional thinking. But the direction of travel is clear. What does that mean practically for someone watching this channel? It means that if you're considering Bitcoin as part of a long-term financial strategy, you need to understand exactly what you're buying. Not a short-term inflation shield. A long-term bet on a fixed supply asset in a world of expanding money supply. A bet that the institutional reclassification of Bitcoin from risk asset to monetary asset is still ahead of us, not behind us. That's not guaranteed, but it's not a crazy bet either. All right, let's bring it together. Bitcoin was designed as an inflation hedge and the logic is sound. Fixed supply, no central control, nobody can print more of it. But right now, Bitcoin is behaving more like a risk asset than a safe haven. It trades with the stock market, not with gold. When investors get scared, they sell Bitcoin and buy gold. That's the current reality. The reason is institutional adoption. The same Wall Street money that validated Bitcoin has also tied its short-term price to broader market sentiment. But the structural case hasn't changed. If inflation persists, if government debt keeps growing, and if trust in fiat currency erodes further, Bitcoin's long-term case as a monetary alternative gets stronger over time. Short-term, unpredictable. Long-term case intact. That's the honest picture. If this raised more questions than it answered, that's actually a good sign. It means you're thinking about this properly. Drop your thoughts in the comments. Do you think Bitcoin eventually becomes a true inflation hedge, or is the gold comparison always going to be a stretch? I genuinely want to know what you think. Hit subscribe if this helped, and check out these 2 videos next. If you want to understand why Bitcoin has value in the first place, that video lays out the full case from first principles. And if you want to understand why Bitcoin's price moves so dramatically, the video on what happened during the US-Iran conflict breaks down exactly how geopolitics moves the market in real time. Stack smart. Stay curious. See you in the next stack.